extremely easy to adjust, and with a couple of strokes, you can change your risk-reward ratio to your liking. In this collar, the options are bought and sold farther away from the market level. Traders would turn to this type of collar if they have a greater conviction in the direction of the market. In our example, they believe very strongly that the market will surge up, and while they are interested in creating a limited risk structure, they are willing to take greater risks on the downside, and in return, significantly increase the upside potential. With this idea in mind, the trader could create the following collar. Again, assuming that gold is trading at the 1100 level. Going long one futures contract at 1100. Buying one 1075 put, paying 5 points. Selling one 1125 call, collecting 5 points or $500. 5 times $100 equals $500. And here too you can find an illustration of the structure on our website. At a glance, two things are apparent. The premiums paid for the put and the premiums collected for the call are equal, though lesser. And the distance between the options and the futures contract is greater. 25 points in this example compared to 10 points in the prior example. This change in structure has an immediate effect on the risk-reward profile of the trade. It results in a maximum greater profit potential of 25 points, and similarly, a greater risk again of 25 points. Let's run two scenarios with real numbers and let's see how this change comes into play. In the first, we'll assume the market plunged and at expiration finds itself at the 1050 level. Here's how it would look. 1. The 1125 call we sold expires worthless, representing a gain of 5 points. 2. The 1075 put we own expires with an intrinsic value of 25 points, representing a gain of 20 points. We paid 5 points for it. 3. The futures contract we are long gave away 50 points, representing a similar loss. 4. Total value of the collar at expiration, minus 25 points. 5 plus 20 minus 50 equals minus 25. 5. Total loss in dollars, 25 times $100 equals $2,500 excluding fees. Now let's turn to a happier scenario, one in which the trader's prediction was correct and the market climbed higher, expiring at the 1175 level. At expiration and at the 1175 level, our collar would look like this. 1. The 1075 put we bought expires worthless, representing a loss of 5 points. 2. The 1125 call we sold expires in the money with an intrinsic value of 50 points, representing a loss of 45 points. Again, we collected 5 points that stay ours no matter what happens. 3. Our long futures position advanced 75 points, representing a similar gain. 4. Total value of the collar at expiration, 25 points. 75 minus 45 minus 5 equals 25. 5. Total profit in dollars, 25 times $100 equals $2,500 excluding fees. As you can see, the only difference between this collar and the one from the prior example is the extent of potential gain or loss. The mechanics of the trade, the underlying mathematical principles of the strategy, remain unchanged. This is completely true for any and all types of collars. No matter where you buy or sell the options, the maximum potential loss and the maximum potential gain are both limited and predetermined. You can see that as long as the options cancel each other, as long as the premium collected is similar to the premium paid, the risk-reward potential are equal to the distance between the options and the point of which the futures contract was initiated. In the examples above, the 1100 level. If, however, the premiums are not similar, the formula for risk and reward is nonetheless very easy to understand. You already have the given, which is the distance of the options from the futures point of entry. If the option you sell brings in more premium than the option you buy, you will end up with a credit. If you do find yourself in this situation, simply add this credit to your potential profit and deduct it from the potential loss. Let's look at an example. In fact, let's use the same 25-point collar we used above. Simply change the amount of premiums to reflect credit. If we sell the 1125 call and collect 15 points instead of 5 points, we would become net creditors to the tune of 10 points. Now let's rerun the scenario, which calls for the market to expire at 1175 and test the results. The 1075 put we bought expires worthless, representing a loss of 5 points. The 1125 call expires in the money with an intrinsic value of 50 points, representing a loss of 35 points. Remember, we collected 15 points that remain ours? The futures advanced 75 points, representing a similar gain. Total value of the collar at expiration, 35 points. 75 minus 35 minus 5 equals 35. Total profit in dollars, 35 times 100 equals 3,500 excluding fees. By adding the initial credit, 10 points, to the previous maximum profit, 25 points, we increase our profit potential by the same amount, 10 points. The opposite process is true in the case of a market making a move adverse to your position. To calculate your maximum risk in such a scenario, you would take the credit collected and deduct that amount from your risk of the futures position, thus lowering your risk by the amount of credit you collected. Let's see what would occur if the market gave ground and at expiration settled hovering at the 1050 mark. At 1050, our new and improved collar would look like this. 1. The 1125 call we sold expires worthless, representing a gain of 15 points. 2. The 1075 put we own expires with an intrinsic value of 25 points, representing a gain of 20 points. 3. The futures contract we bought repressed by 50 points, representing a similar loss. 4. The total value of the collar at expiration, minus 15. 5. Total loss in dollars. 15 times 100 equals $1,500, excluding fees. By deducting the initial credits from the maximum potential loss, we decrease our potential loss by the same amount, 10 points. What you want to remember is that if the tables are turned and you begin the trade with a debit, if you have to pay more for the put you bought than what you have collected for the call you sold, the process we just described reverses. In such structures where debit was paid, you would simply take this initial debit and deduct it from your potential profit, while on the losing side, this initial debit would be added to the potential loss. In our example above, that would bring the maximum profit potential to 15 points, 25 minus 10, and turn the loss potential to 35 points, 25 plus 10. Now that you have some basic understanding of the interaction between the premiums you collect or pay, strike prices of the options you buy and sell, and the risk-reward profile, with little effort you can explore other types of collars. One such structure, on the bullish side, is buying a put at the money and selling a call for out of the money, which is taking more potential risk in the case of a flat or bearish market, while increasing the potential profit if the market explodes upward. For instance, going long one futures contract at the 1100 level, buying one 1100 put, selling one 1200 call. As you can see, this collar is constructed to take advantage of a strong bullish move. Because we are spending precious premium paying for the put we buy, a small move upwards would not cover that expense. A strong move, however, would yield better results than the prior structure because the short call, which limits the profit potential, is far out of the money. A move down, on the other hand, would clearly represent a loss based on our formula. The distance between the futures entry point and the put strike price, plus the debit paid at inception. Since we are collecting a very small premium for the call and paying a hefty sum for the put, we are initiating the trade with a large debit, a debit that would represent our loss should the market become bearish, excluding any fees you may pay. Now that you have a basic understanding of the collar and the tools to calculate the risk-reward profile, you can structure virtually any type of collar based on your view of the market at any given time and circumstance. With that said, we would like to touch on a practical trading issue. Let's talk about legging into a collar. The issue at hand takes place at the actual entry point of the trade. Should a trader place the order as one package, one order buying the put, selling the call, and initiating the underlying market, or leg into the trade? A package means you're either getting filled on all three legs at your requested price, or the order is not filled at all. Legging into the trade means implementing the three legs of the trade separately, or implementing two legs at one time and then the third, or vice versa. If you recall, when we spoke about delta neutral trading and about iron condors, we recommended always placing the order as one package. The logic was that when applying a non-directional strategy, it makes sense not to be directional, even if for an hour or just a few minutes. When it comes to collars, which are all directional structures, some traders prefer legging into the trade. Our position remains, however, and we recommend placing the collar as one package. We take this position because although a directional trade, the structure, when placed as one, offers a limited predetermined risk, legging into the collar may increase your potential profit, but also increase your risk. In order to keep the predetermined risk and rewards level, you must place the collar as one package. With that note, we are concluding our collars presentation. Here's to your success, and remember, there is substantial risk of loss in trading futures options. Remember that past performance is not necessarily indicative of future results, and remember that only risk capital should be used. We hope to see you soon.